The O Cannabis Conference and Expo returns to Toronto June 1st through the 3rd, and there's still some good booth locations available. This exciting event is free for cannabis retailers and will feature Tommy Chong receiving a Lifetime Achievement Award at the O Cannabis Industry Awards. For more information about exhibiting or to register to attend, go to ocannabis.com. That's OCANNABIZ.com. Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today we're going to do another financial market recap. So let's jump right into it. We see that the Federal Chairman Powell made history by unleashing a record buying panic in stocks. So he had the biggest buying panic in history on the morning of the 18th, when according to the New York Stock Exchange, there was a record 2,049 stocks that saw a positive tick moments after the open, the highest point on record. Investors are in a buy everything mode on hopes that lockdowns are easing and a virus vaccine is on the way. So that's a whole lot of optimism, which presents some opportunities for traders to buy some of that volatility as it moves sideways for a while until it takes the next dip, which could happen if the Fed launches negative rates. The Fed has not ruled out negative rates, suggests that the Fed likely has adequate legal cover to implement, but I guess they're not expecting some pushback from anybody because the Treasury announced that it was in the process of building the operational capacities to allow for negative rate bidding in the Treasury bill auctions. Negative rates are an issue for a lot of people. If you have savings that say they make it where it's 100,000 or a million, you'll be charged for having your savings in that account. So it's also going to hit other investments like mutual funds. So there's an issue with rates with stable net asset value funds. The issue is that the value of those will decline by virtue of investing in negative yielding assets. So for a lot of these mutual funds, what they'll do with their total client credits or the total amount of customers that they have, for example, like E-Trade, what they'll do at the end of the day for anybody who's not invested, they'll put that money into a money market account. That money market account is probably a closed-ended mutual fund that they have exclusivity over, and that's their total client credits that they kind of house all of their clients' cash that they're not invested. If that's negative, that poses a problem. So they're going to be charged for having that money instead of earning money. Obviously, that's an issue. Banks will also take a hit. They take earnings on a negative interest rate environment that they have lower margins, so they'll have a reduced capacity at the bank to absorb losses. So they're going to have to figure out how to operate in a completely different environment. So the U.S. government is printing off trillions of dollars. Now they're going to have negative rates. Can inflation wipe that away? If the government tries to inflate their way out of debt, the bond markets will demand a price. And because when a bond matures and a new bond takes its place, that inflation uncertainty risk will eventually be charged for all of the outstanding debt. So you have a risk for every time a bond matures, that inflation risk or that maturity risk, interest rate risk, whatever you want to call it, is there. Right now, we're seeing that 30-year bonds have the same amount of risk as like a 3-month bond. And so normally that's not the case, but short term, long term, nobody knows what's going to happen. And so you can't price in inflation when you don't know what the certain risk is. Problem is when you have high inflation and debt reduction that almost never takes place at the same time, and somebody knows that, there's a mysterious investor that dumped $333 million in real estate exchange traded funds in the dark pool trade, meaning that they just open that up to institutional investors or other banks. So this amounts to about 7.4% of outstanding shares in the macro indicator for the industry's largest companies for real estate. So when an insider with 7.5% drops $333 million, it's kind of a sign that something big might be happening. As you can see, there's also commercial real estate apocalypse that's about to happen. So the historical delinquency rates of collateralized mortgage-backed security defaults are on the horizon. So a V-shaped recovery is not likely. It's probably going to take about 3, maybe 4 years for the recovery to take place for the economy to re-accelerate. So we've had some warnings that commercial real estate was in a crisis, that tenants weren't paying rent, and that was going to affect everything all the way down to a real estate investment trust. Well, now Congress might bankrupt the mom and pop landlords with a new bill. So the emergency rent and mortgage cancellation legislation was first floated around in Congress that mandated payment cancellation for all rent types effective April 2020 and lasting the duration of the national emergency. During that time, no one could be evicted for non-payment of rent, no interest, no late payments. So landlords could apply for help with the payments, but there's a catch. Under the emergency rent and mortgage cancellation legislation, if the landlord gets help, he then has to agree to some terms. So there's a rent freeze. They have to have just cause evictions. And that means that the landlord can't evict a tenant who doesn't pay. It also means that the landlord can't evict a tenant who vandalizes a property, rips out all the appliances, equipment, furnishings, threatens other tenants. Also means you can't evict for petty crimes, only for serious crimes that threaten your life. And the national emergency may never end. It may never fully lift. There's a lot of national emergencies going all the way back to the 60s and before that that are still in place. So that could create a tidal wave of delinquent mortgages set to surpass the Great Recessions, which peaked at 10%. Oxford economists predict that as many as 30% of Americans with home loans, or around 15 million households, will stop paying if the U.S. economy remains closed throughout the summer or beyond. So there's going to be some consequences. All of this printing is going to add up. So we can see that the balance sheet is stacking up. Corporate issuers have had no trouble issuing debt as of lately. Apple just issued $5 billion in bonds or debt in order to buy their stock back. So that's absolutely insane to issue debt in order to buy equity. They also had $58 billion in revenue, and they're going to spend $50 billion of that 58 to buy stock back as well. One of the consequences is going to be a 20% decline in GDP. That equates to roughly a $10 trillion reduction in debt as default, bankruptcies, and restructurings rise. One of the other consequences is with the unemployment, you're seeing 68% of unemployed workers that are eligible for payments that are greater than their lost earnings. So it's going to be incredibly difficult to find a job in the coming months ahead. So it kind of makes sense that for individuals that are not making a lot of money, that they're going to continue to remain unemployed and ride this gravy train, where those that were making a lot of money will probably just get back to their job. But for 68% of the people saying they're making more money on unemployment than their job, that's crazy. So as millions of Americans skip on credit cards and car payments, U.S. banks are on the hook for $150 billion in frozen loans. Banks will have to take out another $75 to $100 billion in reserves on loans that go bad, wiping out years of profits which were used for a rainy day fund, but now have to pay for buybacks maybe. But right now there's forbearance programs from March that are nearing their expiration dates, when many of the banks are set to decide on whether to continue letting people off of the $150 billion of debt, including credit card balances and personal loans and car payments. So we've talked about the oil market. We've talked about the automotive industry. Now we're talking about the commercial, residential, real estate market. And either way, there's going to be a deceleration that's going to occur on all asset fronts. So when the next financial wave hits and there's a supply chain disruption and a finance debacle where all of the banks there's some bank runs, Deutsche Bank, for example, there's going to be a lot of issues. And so nothing is going to be sacred. You will see crypto come out of nowhere and get to all-time highs, gold and silver eventually, but for the paper markets, those all have to disintegrate. Crypto is immune to that. They don't have paper markets yet. There aren't options on the stock market for those yet. It makes gold even that much more important, as it's the best performing asset in 2020 with a 15% gain in US dollars. Gold's 18% higher in euros and 23% higher in sterling. Gold is now outperforming the 30-year bond and is the best performing asset in 2020 year to date in all currencies. It's even outperforming the tech giants in the NASDAQ, only 6.8% higher year to date. The gold to silver ratio has fallen from 125 to 100 as silver starts to outperform gold again, as it does in gold and silver bull markets. Silver remains very undervalued versus gold, versus property markets, and versus risk assets in general. Silver has underperformed gold in the short and medium terms and is only 1% higher year to date in dollars, 4% in euros, and 9% higher in the British pounds. So silver's finally joined the gold at the party, increasing in value from 1551 to 1735. That's an 11.9% increase. So with the jump in price of silver, the silver to gold ratio has dropped to 101. Earlier in May, we reported that silver hasn't been this undervalued when priced in gold in over 5,000 years. At its peak in March, the silver to gold ratio hit an all-time high of over 125 to 1. The silver to gold ratio tells us that while the white metal is still significantly undervalued, history tells us that silver will eventually close the gap with gold. So it means that gold will either drop or silver will rise. So given the economic dynamics and the current extraordinary monetary policy, a continued gold bull run seems more likely, and silver will probably come along for the ride. So invest wisely. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.
Hi, y'all. I'm Joe, host of Casually Baked, the podcast. If you're curious to explore the highly responsible side of cannabis, farming, and legalization, I'm here to help lighten the stigma and build your canna confidence. Download episodes now of Casually Baked, the podcast, wherever you listen to podcasts. And journey with me through the evolving cannabis culture and discover how and why people like you are adding cannabis to their wellness toolkit. It's time to get casually baked.